Nike stock has recently come under pressure, and yet it remains a $150 billion brand built by leveraging the celebrity athlete exclusive endorsements. You can look at the Jordan brand up around 30% in terms of sales last year alone, generating $6.5 billion in 2023. Looking at Nike since its IPO'd, monster stock, a real strong lesson in that if you find something that you think can compound for years ahead, it's less about how are you doing in a given quarter, but what do you think is that long-term growth rate, and do you have the stomach to sit on it, to sit and own that volatility? Because long-term, if you have that compounder, you generally do well. And so looking at Nike stock since it's IPO'd, nearly 48,000% return, and yet the stock has recently come under pressure, causing investors to wonder, has the growth story been broken? Where does it go from here? If you enjoy educational investment videos, you're watching Unrivaled Investing. My name is Daniel. We're going to go through Nike and their current operations, as well as my thoughts around their valuation, why the stock has recently come under pressure. So if you enjoy these types of videos, please make a point of hitting that thumbs up, hit that subscribe button. And so let's go through, what does Nike currently do? So what you're really looking at is primarily wholesale, representing around $27 billion in sales. And it's important to recognize this. So there's different channels that a brand can use to sell. This is very different from when Phil Knight was trying to sell his Tiger shoes out of his car, the founder of Nike. And so now you're leveraging a wholesale channel, and this is the primary way, $27 billion. This is their largest channel. Now, there's some pros and cons to this. The pros of which is that you can leverage the traffic that these stores have. The downside is, as you can see in this picture, I believe this is a Costco warehouse, is that there's a lot of different brands out there. So you do not control, what the consumer sees when they get there. They're going to say, oh, well, I can buy Nike and maybe the boxes are a little dinged up and, maybe it's not the right size and it's right next to these other brands. And so there's this trade-off of, hey, I'm not going to get the best margins. I'm not going to get, the exact consumer experience that I necessarily want. I'm not necessarily building that direct to consumer relationship where I won't know exactly who's buying it, but I do get a lot of traffic. And so that traffic is well worth it, because historically, a lot of these brands didn't have the power to directly connect with the consumer. So this alone, $27 billion of Nike brand revenue. The direct to consumer channel, that's been growing faster. That's around $21 billion. That's leveraging both the Nike stores as well as their online presence. Now, the strategy here is a little bit more complex, because you have to deal with the legacy wholesale business and say, hey, well, we don't want to completely undercut it, because those are some of our key partners. But we can also get better gross margins. We can get better profitability by owning that customer relationship. Maybe, someone goes to the website, we have to spend more on marketing maybe, so that way they go to our site to buy the product that they're interested in. And maybe there's more logistics costs because, someone can buy it and maybe the size doesn't fit and you have to deal with returns and that type of complexity, the logistics, the fulfillment of it. But the flip side is you can own that relationship. And maybe, once you own that customer, you create that recurring profitability. And so that, that's the changing dynamic that you have with Nike right now. The legacy wholesalers sort of coming under pressure over time, not growing as quickly as the online business, and the direct business is doing very well, growing at a good clip. And they also have, in addition to the key Nike offerings, you do have some diehard fanatics in Converse. Some people even get married in these shoes, like my brother. $2.4 billion in sales. That's as it pales in comparison to the Nike brand, which, as you can see, is tens of billions of dollars in any given year. When you're looking at Nike, it's, you might think, well, wait a second, there's apparel, there's equipment. It's really a footwear company. Around 70% of their revenue is tied to footwear. So it really comes down to, will people continue to buy their shoes in the future? That is the vast majority of this business. And, folks are looking at the stock down around 15% over the last 3 years. This includes dividends. This includes buybacks. What's going on here? Why is it, coming under pressure? Will it continue to make new lows ahead? Is this an example of just don't do it? Because the stock really hasn't delivered recently. So I quickly ask AI Ticker Chat, why is the stock, coming under pressure, or why might the stock actually drop based on looking at their annual report, looking at their latest earnings, look at their, last transcript. And keep in mind, the first month for AI Ticker Chat is free if you want to play around with it yourself. And so I'm asking, why might Nike trade lower on this results? And I think it nails it here. It talks about how the gross margins have decreased, talking about the cost of producing goods has increased. So effectively, you're looking at higher raw material costs, higher labor costs, increased logistics expenses. This can have a short-term impact on the company's profitability. Another key aspect is facing intense competition. I've personally looked at different, some of the other competitors. It's not exactly apples to apples comparison. You look at a Crocs, you look at a Skechers, and you're looking at growth rates that might say, hey, maybe your shoes aren't growing as fast. But overall, I still think Nike is doing very well in the shoe department, in terms of how they're delivering. I don't think the competitive dynamic is really eating away yet. I mean, if you have a different perspective, would love to hear it. But I think the margins, that's the real story here, because when you look at the financials, you see their gross profit only increased 2% in the most recent quarter. For the year, it only increased 4%, despite the fact that revenue was up 5% and 10%. You also had a strong US dollar impacting these results, but this change in gross profit, not keeping up with revenue, reflects that the cost of sales outstripped the revenue. So maybe they raised prices, but their input costs went higher, outpaced the price increases and outpaced the increase in volume. And they also had a higher, the amount of costs in terms of running the business also outstripped their change in gross profit. And so you're looking at these things, and you're looking at, in the most recent quarter, a decline in earnings per share of 27%. For the year, a decline in earnings per share of 14%. And when you're looking at figures like this, it's really hard for an investor to get excited and say, hey, this should warrant a premium valuation multiple. And keep in mind, Nike currently trades around 30 times earnings. When you see an earnings decline, it's hard for an investor to say, hey, I should want to assign an even loftier multiple. And keep in mind, in the short term, it's the valuation that changes the bulk of the price. Long term, over a decade perspective, it's really revenue growth and profitability that drives the business. And so in the short term, in the last 6 months, last year, what you're really looking at is valuation compression, because investors are saying, hey, I'm not super excited about this. I'm less excited, combined with weaker fundamentals. So you're looking at both of these things hurting their results. So where does Nike go from here? First of all, in full disclosure, this is not financial advice. Also, a quick plug: if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. By the way, I'm raising rates soon, so now's the time to lock in the favorable pricing. So thinking about, where does Nike go from here? Once again, I check in with AI Ticker Chat. There's this new feature called AI Predict, and it nails it. It largely gets it in line with my own views, thinking about where could Nike go in the years ahead, saying, look, maybe you get, high single digit growth in the next 5 years. Maybe you get, 10 to 15% profit margins. Maybe it trades at a, 20s times plus earnings multiple. And when you, assume these different components over the next 5 years, you're effectively saying maybe it's down, 30 to 40% annualized over the next 5 years. Maybe it's up between 50 and 100% over the next 5 years. When you include the cash flow that they generate, maybe it's closer to 100%, but not penciling out something that's crazy compelling, looking at something that's okay, pretty good. So I start thinking about, okay, let me put in my assumptions myself. And keep in mind, in the prior, example with AI Ticker Chat, you can type in, your own assumptions in the yellow tabs, but, creating my own sheet, thinking about what's the price that I would personally want to pay, what price would get me a little bit more interested in. Currently it's around 95. Wouldn't surprise me if it rebounds, just because it has come under pressure the last few months. But I would personally want to see it closer to that 20 times earnings multiple. So closer to a $70 share price, closer to a $100 billion market cap versus the $95 share price that it currently trades at. And part of the reason why is because, at 30 times, you still have that potential risk for valuation compression. And you need to see them really deliver on better margins in the year ahead versus what they just did. Now, they might do it. My 10% is assuming that they don't really do it. 15% is assuming that, they get back to near record levels in terms of profitability. And so, that does have an impact on what you think is the multiple. But overall, I would rather, sort of underwrite or invest in a situation where I don't have to worry too much about valuation compression. And I do share what I'm personally buying to my subscribers, once again, at unrivaledinvesting.com. Personally, I look at Nike, very impressive story. I'm not as worried about the competitive dynamic right now, as I'm looking at this thinking this looks like short-term challenges with input costs and inflation. Now, short-term challenges can last for a few years, but I don't view the underlying thesis as busted. When you see core brands like Jordan still growing 30% a year, I think they really do have a value proposition that resonates with their customers. The 70% of their market or 70% of their revenue in footwear, I don't think that's going away overnight. There would be red flags along the way if the thesis starts going against you. So far, I think it's favorable, but I wouldn't give this the thumbs up and wouldn't say, hey, this is a stock that I think could definitely or has a high probability of outperforming the S&P, let's say over the next 5 years, because it's still trading at, let's say, 30 times, what is a weaker operating margin, but it is closer to 30 times earnings. It wouldn't surprise me if that comes under pressure over time. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.